Gro- and gross national income record the income of Pakistanis across the globe. So one is within the borders of a country, and the other one is income of people of that country, income of that country nationals, whether they're living in that country or they're living abroad. Are you getting me? Just follow the class and everything we get through. Everything will be easy and clear. In case there is anything confusing, I'll explain you again. Don't worry. What is gross? What is national income? So national income is the total income of all people living in the country. Easy, simple. Now, how do we calculate? How do we calculate national income? So national income is calculated. National income is calculated through GDP, right? Now, what is GDP? GDP is gross domestic product, which is the total value of all goods and services produced in a country, right? Is it making sense? Right? So that is what gross domestic product is. Now think about this. What you are talking about, is gross national product. Now let me tell you a little bit of difference between GDP and GNP. Gross national product is the income of only certain of country nationals, regardless of their place of residence. Now think about this. Whether a Pakistani is living in Pakistan or outside Pakistan, if we add up their income, that is what gross national product is. National, you can remember it like this. So national product, GNP, gross national product, will only record the income of Pakistani nationals, whether they are in Pakistan or outside Pakistan. Whereas gross domestic product is border based. It's a location based thing, right? So whatever is produced within the borders of that country, that is defined as GDP, gross domestic product, right? Whether that is produced by Pakistani businesses, Pakistani nationals, or non-nationals who are living in Pakistan, right? So at any point in time in any country, there are non-nationals living, like in Pakistan, we have Chinese working, we have Americans working, we have other country nationals working, right? So GDP will include income of all those people, but gross national product will only include income of Pakistani nationals, whether they are in Pakistan or outside Pakistan. Is this making sense, Mubin? Is this making sense so far? Right? Right? So GDP is what? Borders of that country, whether they are or not. As simple as that, right? Okay. Now, this being said, so the first measure, the first national income statistic is GDP. Then the second national income statistic that we just discussed is GNP. So I did tell you that there are different metrics or different statistics to calculate national income. So far we have talked about two: GDP, gross domestic product, income of all people who are living in Pakistan, whether they are Pakistani nationals or not. And GNP, gross national product, is only the income of Pakistani nationals, whether they are living in Pakistan or they're living outside Pakistan, right? Okay. Now the big question is, how calculate GNP from GDP? Now that's another important question you should be thinking about. How do we calculate GNP from GDP, right? Now think about this. The idea is that gross national product is equal to gross domestic product plus net property or net income from abroad. Now think about this. I will explain you and then move on. Net income from abroad is basically equal to income by your country nationals living abroad minus income earned by foreigners living in your country. Okay, now have a look at this. Now, the idea is that, think about this. GDP has already recorded. So let's assume that Pakistan's GDP is $300 billion. Maybe. So let's say in a given year, Pakistan's GDP is standing at $300 billion. But we want to calculate gross national product from this, right? So we want to record the income of only Pakistani nationals, right? The problem with the GDP that we calculated, which stands at $300 billion, is that it also includes income of non-Pakistanis who are living in abroad. Yes or no? It does include income of non-Pakistanis who are living in Pakistan. And it does not record income of Pakistani nationals who are living abroad. Yes or no? Is that correct? Right? So if we have to calculate GNP, income of only Pakistani nationals, so then in our GDP, we have to add income of Pakistanis, our nationals who are living abroad, and subtract the income of foreigners living in our country, right? And that is basically net income from abroad. Sorry, not abroad. So this is what net income from abroad is. This is making sense, right? So when we add net income from abroad to the GDP, what do we get? GNP, gross national product. I'm assuming this will um, be making now more sense to you, right? Maybe, but do ask me if there's any question, right? Let's look at this one more time. GDP include income of all people who are living in your country, whether they're Pakistani nationals or they're not. GNP only, perfect. GNP only records income of your country nationals. So if we have to calculate GNP from GDP, what we'll do is that first of all, we will add income of our country nationals who are living abroad, right? So that's being added, income earned by your country nationals living abroad, but subtract income of non-nationals who are living in our country, right? Like foreigners, right? Okay. Now, this being said, now the next thing is the third national income statistic is net domestic product. This is what you were talking about. What is net domestic product? Nothing about this. The problem with gross measures is, now this might be a little tricky, but I'll help you understand. The problem with gross measures is that gross measures do not estimate how much depreciation. What is depreciation? So basically depreciation is the wear and tear of assets. When you use your assets, obviously they lose value, right? Of assets during certain time period. Okay. Now, the idea is that, let me give you a simple example. So if you, let's say, purchase a car, now that car will not stay as good as it is right now, right? If, let's say, similarly, you buy a new laptop, or if you buy a new cell phone, then that phone, that laptop, whatever it is, will not be as good as it is right now, right? Its condition will deteriorate, its performance will deteriorate. You might, in fact, you will need some maintenance on that to, maintain its performance and all that, right? And when you'll sell it later on, it will be sold for much less value compared to the value you bought it for, because obviously when you're selling it, its value has decreased because of the wear and tear and because of the usage of that product. Now, coming back to the point, the idea is fairly simple, that when in an economy, these businesses are producing something, there could be manufacturing businesses, there could be services, whatever business it is, it has some assets. It has production machinery, it has laptops, it has office equipment, furniture, building, whatever, right? All of these are assets for a company. So when they produce some product, could be a good, could be a service, they used those assets to produce those products. Now, whatever wear and tear those assets had, right, during that time period. So that is kind of an expense. That is kind of, that is kind of an amount that was lost because of production of those goods and services. Maybe, are you getting? So if you do take accounting, you will have a better idea, but that's what I can simply, tell you. So let's think of a car. You buy a car for 20 lakh rupees, and let's say every year its value is decreasing by two, like you expect it to last for 10 years. 20 lakh worth of car you bought, and you expect that car to last 10 years, right? So then in that case, we are assuming that every year it will be losing value of 2 lakh rupees. Every year when you use that car for traveling, and here and there when you go use that car for traveling, so it will lose 2 lakh rupees per year. So that is its depreciation. Now, why are we subtracting depreciation from the national income? Because that shows the amount that you lost, the value of assets that you lost due to production of goods, right? So technically that is a better measure. That's a better measure of, value that you produced. So it's just like saying, think about this. If you, you must have seen that there is gross weight and there is net weight. So if you go to buy some product from, let's say, a shop, and let's say you're buying peanuts, so the packet has gross weight of 500 grams, but how much is the net weight? How much is the weight of the peanuts that you're buying? That's the net weight. So that's the actual amount or value of peanuts that you're buying. Are you getting me? So what you do, that gross domestic product minus depreciation will give you your net domestic product, right? So NDP is a better measure of national income as it accounts for the lost value of assets, which is basically the amount businesses spending to replace those assets, right? Are you getting me? Mubin, did you get this part? So it's just like saying that if I offer you a job, right, worth 20,000 rupees. So the job is worth 20,000 rupees, but the expense that you have to make to come to the job, like the travel expense, so that is your additional expense. So that is not giving you a value. In fact, you are spending value to go to the job. You are spending some amount to go to the job. So if you have a job of 20,000 rupees and you have to spend 3,000 rupees for traveling to that job, so technically how much you saved at the end of the day? How much is your net gain? Your net gain is only 17,000 rupees, because 20,000, even though I'm paying you 20,000, right? But 3,000 was spent in going to the job, which will help you earn 20,000. So 20 minus 3 is 17. So 17 is your net gain. So similarly, net measures are better in the sense that they account for the depreciation. So when you used assets, when businesses used assets to produce those goods and services, so they lost some value, and you are accounting for that value that you lost, right? Easy. So that was net domestic product. And similarly, the fourth and the last one that you have is net national product. Now, similarly, what you will do to calculate net national product would be very simple. So you subtract depreciation from net national product, right? So gross national product minus depreciation is your net national product, right? Is this making sense? Okay, now that's the idea. So these are the four measures of national income. Any confusion so far? Any confusion so far? Anything that's not clear? Gross domestic product, right? Okay. Now, this being said, the last one. Okay. Now think about this. What was gross national product? Gross national product was the income of your country nationals, whether they're living in Pakistan or outside Pakistan. So if you subtract depreciation from gross national product, how do you calculate gross national product? We did look at it. So to calculate gross national product, you have to add net income from abroad. You have to add net income from abroad, right? Okay. Now, when you subtract depreciation from gross national product, you get net national product. You get net national product. Easy, right? So just like you subtracted depreciation from gross domestic product, you got net domestic product. Now, similarly, when you subtract depreciation from gross national product, you get net national product. Is this making sense? So why are we subtracting depreciation? The reason is the same. The reason we are subtracting depreciation is because we are accounting for, perfect. So we are accounting for the lost value, the value that our assets lost in the process of producing those goods. That's why we are subtracting depreciation from gross measures. So net measures are more accurate representation of, the value that a country produced during a certain year, right? Which gross measures are not capturing, right? So just like the example that I gave you, if you think about it, the 20,000 worth of job, 20,000 rupees worth of job that you got is good, but you do need to account for the expense that you will have to spend on going to that job, right? So that is not a benefit. So you subtract that. So 20,000 minus the expense of going to the job, which might be 3,000. So in net gain, how much do you get? That's only 17,000. Easy, we good? Okay. Now this being said, we'll move forward, right? Then other things that we wanted to cover, which are part of our syllabus, are, right? How do we calculate national income? How do we calculate GDP, right? Yes. Gross domestic product is the basis for calculating all other measures of national income. That's correct. Gross domestic, that is the reason why it is the most commonly used measure. So most of the times you'll see that countries calculate their GDP, right? And oftentimes when you go to Google and wherever you want to look at this, so you will find gross domestic product most commonly quoted. And the reason is fairly simple because, that's most commonly used metric, right? Calculating all other national income statistics, right? That's correct. Very nice. Okay. Now, then think about this. The idea is, how is GDP, or simply speaking, methods for calculating GDP, right? Methods used for calculating GDP, right? So there are three methods that we'll use for calculating GDP, right? So there is income approach, then there is expenditure approach, and then there is, then there is expenditure approach, and then there is value added, or we also call that product approach, right? Now, how do countries calculate GDP in reality? That's what we're talking about. So theoretically, I mean, it's very simple. If you remember in AS, you must have studied that where the aggregate demand of a country is equal to its aggregate supply, that is the value of the GDP, which kind of makes sense, right? So just like we look at the market equilibrium, where the demand and supply intersect, right? That is where uh, the market outcome is. Similarly, the way you calculate GDP is basically, let's put it down like this: aggregate demand and aggregate supply. So where the aggregate demand and aggregate supply of a country intersect, that is where its GDP is, right? So simply speaking, downward sloping is your aggregate demand, upward sloping is your aggregate supply. Wherever the two intersect, that is your GDP, right? How much value of goods and services you produce, 300 billion, 400 billion, whatever it is, right? Now, coming back, to this, but how do you calculate in real life? Like if I have to calculate the income that everyone generated in Pakistan, how a country goes about it. Income approach is one of the methods. Now, what it does is it is summation of who are living in a country during a certain time period, which is basically estimated through income tax returns. Okay, now have a look at this. Right? Uh, the idea is, Mubin, right? So we just talked about that in economics, theoretically, how is GDP determined? So GDP is determined where the aggregate demand, is equals to its aggregate supply. That's, simple idea, that where the aggregate demand, which means what is the total demand for all goods and services in an economy. What is aggregate supply? Aggregate supply is the total output that is being produced. So the demand and supply has to be equal. The demand and supply has to be equal uh, for, for it to uh, be GDP, right? So just like in a simple product, the demand has to be equal to supply to determine the market outcome. Similarly, in macroeconomics, where the aggregate demand is equals to aggregate supply, that is where the GDP of a country is. Easy, we go on this? Okay. Now, what are the methods used for calculating GDP? The first one is income approach. What is income approach? So income approach is summing up income of all people in a country, right? And how do we do that? How does that actually happen, right? So basically, when people file their tax returns, right? So I earn income, I'm employed at an organization, at a business, right? So whatever income I earn, I have to inform the government income department that how much income I earned that period, because on that I also have to pay tax. Similarly, businesses also file tax. How do they file tax? They have to pay sales tax, they have to pay corporation tax, right? And other type of taxes and all that, right? So when businesses are reporting their income, and individuals are reporting their income from the job or the employment that they do, right? So when you add up the income of all the people, all the businesses that are located in that country, that is what help you calculate the GDP of that country through income approach. This is income approach. Amna, quick recap. By the way, you are late. I mean, we are doing crash course, and joining classes late will mean that you will be missing out on a lot of stuff, right? But let's try to have our classes at 7, right? If there is clash, do let me know. I'll see what I can do around that. I'll give you a quick recap of what we have discussed so far, but first let's complete off with what we are doing right now. So right now, just focus on what we're doing, and towards the end of the class, I'll give you a recap of what you missed earlier. Okay, now is everyone clear on this? Students, are we good on this? Okay. Now, then another method used, or another approach used to calculate GDP is the expenditure approach. Now, what is expenditure approach? Expenditure approach is basically calculating the expenditure that all the people made. So we are not looking at how much we earned. So the government is not looking in expenditure approach how much they earned, because that was income approach. In expenditure approach, what government does is that government add up the expenditure of all the people. Now, let me give you an example. Now, listen to this very carefully. Whatever income I earn, where do I spend it? Let's think of an individual's example. Whatever income I earn from the company where I'm working, I spend that money on buying fuel. I spend that money on buying groceries, right? Obviously, food items, groceries. I spend that money on paying electricity bill, gas bill, rent, clothes. I don't know, so many other things, right? Now, all of that is recorded somewhere. All of that is recorded somewhere, right? So when I go to my gas station, and I get my buy fuel for the car, right? So I pay them either in case of cash. I mean, it's kind of slightly difficult to track, but otherwise what I will do is that I'll be paying them through debit or credit card and so on, right? So that is a transaction that's recorded. At the end of the day, they will calculate how much worth of sales they made. And when I go to departmental store to buy groceries, I pay through my debit card. Even if I'm paying through cash, that will be in their financial statement showing up that this much worth of sale they made during certain time period and all that. So if you add up the if you add up the expenditure of all the people in that country, that will give you the GDP using the expenditure approach, right? Um, it is, right? So what is expenditure approach? On goods and services during time period. Easy, we're good on this, right? Uh, this approach seems way too messy. Okay, okay. Now that's a good question. Let me answer that for you. So Mubin is saying that this, so what I understood from your question, Mubin, that you're saying that it might not be able to track all expenditure. And correct me if that is what you meant by that. That expenditure approach might not be able to, capture expenditure of all the people in the country. Is that what you meant? Okay. And the answer to that is yes, right? Now, this is very important. Students, now listen to me very carefully. If let's say you wouldn't have been right, if if you wouldn't have been what's that called, uh yeah, okay, okay, perfect, account for, yes. So the idea is that let's say if you would not have been taking classes through mega lecture. Now the thing is that mega lecture is a registered entity, right? So at the end of the day, at the end of the year, we have to file our tax returns. We have to tell the government income department how much worth of sale we made, and how they will, obviously the government income department will then calculate how much is the tax that we have to pay and all that, right? Now that's how it goes for a registered business. But let's think about it. If let's say you and I are neighbors, and you know that Kasim is economics teacher and he can teach you well and all that, right? And then instead of going through any company or going through any registered entity, you only request me to come to your home, or you come to my home and I give you some tuition classes and you pay me in cash. Now that is one transaction that is not recorded anywhere. Are you getting me? Moving. So that is one transaction that is never recorded anywhere. So I can afford to not declare that income in my income tax. Are you getting me? Because it's not a registered business. They don't record their financials and all that, right? So it's just a kind of gift. You're giving me cash, but for what? Right? So I can understate my income. So similarly, there is oftentimes the case when I go to shop, think about all these retail shops in your vicinity, right? So not all of them, yes, I won't be taxed for that income. I won't be taxed for that income. That's correct. That's absolutely correct. But these are very smaller transactions. These are very smaller transactions. I mean, so the government is not very much concerned about it. And it is generally a problem with developing countries, and we call it informal sector. What do we call it? We call it informal sector, right? Where transactions are not being recorded, right? Easy. Okay. Okay. Now, similarly, just like people can evade their income tax because they're understating their income. So think about this. The idea is fairly simple. When you understate your income, your actual income will never be known to the government, and therefore they can't tax you on that. Similarly, there will be times when your expenditure in the country is understated. Why? Because you go to small retail shops, right? Very small retail shops. Sometimes they might not be filing their tax returns and so on, right? Sales tax, they have to file sales tax, but let's say they're not filing their sales tax and so on. So then whatever spending you're making, whatever products you're buying from those retail shops will not be part of the expenditure, the overall expenditure in the economy. And therefore that would never be recorded. Are you getting me? That would never be recorded. So that is basically understatement. But expenditure approach is still a better method to calculate GDP, because write that down for you. GDP, since it is easier for people to understate their oh, is to understate their incomes, but it is hard, it is difficult for them to hide their expenditure, right? Is this making sense? Right? But it is difficult for them to hide their expenditure. Easy? Is this making sense, right? So think about this. I'm not saying that all expenditure is being recorded, right? Expenditure is through registered businesses, and therefore some consumer expenditure will be unaccounted for, but its chances are fairly less compared to uh, income approach, where people understate their incomes to evade income tax. Is it making sense? Right? Relative difficult, I mean, they still can hide their expenditure. I mean, yeah, but hiding their expenditure is difficult. Think about it. Okay, so hiding my expenditure is not up to me. Movie, you have to understand this thing carefully, right? Now, when, let's say, if I go, right, let's say I was taking that example, let's kind of build on that. So I and you are neighbors, right? So you come to my home, you pay me in cash for tutoring, for me to tutor you economics, right? And that amount, I go to a departmental store, I go to that departmental store and buy something, right? Now that would be recorded that this much expenditure was made, because they have, that's a registered business, they make their financial statements, everything is, you must have seen the payment system, the way it works, that they have barcodes on all the products and everything is automatically recorded in the softwares and everything, right? So I can't hide that over there. So understating my expenditure is not on me, it's not on the consumer. It depends on what products and where you're buying your products from. Are you getting me? Similarly, if I go to a salon, a registered business, or if I go to a movie cinema, right? So these are registered businesses where they will tell the government how much sale they made. But for income, I'm not stating that income. So are you getting me? There's a little fine margin. Like there is still low chances of expenditure being unaccounted for as much as income is unaccounted for. That's what I'm trying to say, right? In both there is margin, but income could be more understated. You must have always heard these scandals, right? Billionaires, millionaires not paying enough taxes because they never show. What they do, they have a lot of waste. Instead of claiming certain income by themselves, what they do, they get the business registered on other people's name, and then they put it in charity, some income, they donate something. I mean, there are a lot of loopholes in every country, and that's how they, kind of go about it, right? So that's the idea, right? Okay, now let's quickly recap this and we'll move forward. Even though not all expenditure is through registered businesses, and therefore some consumer expenditure will be unaccounted for, but its chances are fairly less compared to the income approach, where people often understate their incomes to evade income tax. That's the idea, right? Okay, now moving on to the third and the last method used to calculate GDP, and that is product approach. Now, what's product approach? So uh, it is when value added is uh, or let's put it down like this. It calculates GDP through value added approach, which is basically the difference between selling price and cost of components, right? Easy, right? Okay. Now, what is this? I don't know if you take business studies or not. Even if you don't know worries, I'll explain you what that means. So product approach calculates GDP using value added approach. Now, what's value added? Now, let me give you an example. So let's say there is a textile mill. Now you have to listen to this example very carefully, right? So there is a textile mill that manufactures clothes. Now, if you buy raw cotton, right? If you buy raw cotton, let's say one shirt uses 5 kg of raw cotton, right? 5 kg of raw cotton is used on each shirt. And the price price of 5 kg of cotton in the market is, let's say, 1,000 rupees. How much? 1,000 rupees price of 5 kg of cotton. Is it making sense? Movie, right? But think about this. When you will dye that shirt, when you will cut that shirt, when you will basically make a t-shirt out of that 5 kg of cotton, right? Now that t-shirt will be worth much more than 1,000 rupees. Do you agree with me? Right? Now, what happened? Why, even though it only used 5 kg of cotton and perhaps some, some design, some, what's that called? Some colors and so on and so forth. But why is that t-shirt in its finished form much more valuable compared to the raw cotton? Because there was some process that was undertaken. So if you go and buy vegetables, raw vegetables, they cost you less. But when you go and you buy, a meal in a restaurant, that costs you more, because obviously there was some cooking went in. There was it's a cooked finished product that use spices, that use the technique of cooking and all that stuff, right? So there was a process that was used on that. So coming back to the point, right? So it calculates, sorry, my bad. So what is product approach? So product approach, it calculates GDP through a value added approach, which is basically the difference between the selling price and cost of components, right? So that is what value added approach is. So if you add the value added to all the products in a country, uh, estimate country's GDP using the product approach. Easy, we got this? Right? So the third method to calculate GDP of a country is using the product approach. And what's product approach? Product approach is basically you add the value added for all the different products and for all the different industries, and that give you the GDP of that country, right? I mean, this is a little more complicated and it's hard for us to understand exactly how this will be done, but this is not a very commonly used method, right? Let me add it over here. Commonly used for calculating the country's GDP. Right? Easy. We got on this? Any confusion so far? Okay. So which are the commonly used methods? Obviously, the income approach and the expenditure approach. In terms of value of all final goods, value added through production process. Value of final goods, yes, minus value added through production process. Okay, now moving, yeah, you are thinking, your idea, you have an idea about value added, but I mean, you will say, oh sorry, I did not write this down. So value added, let me write down the formula for you. So value added is basically selling price of final good, minus cost of components. Now components would include a lot of different things. So it's just like saying, let me give you another example. Um, so let's say, think of a cell phone. right? So let's say a typical cell phone sells for 30,000 rupees. Now that is the selling price of the final good, right? 30,000 rupees. How much cost you spend in making that phone, like the plastic that was used, the microprocessors, the the engineering products, like the tech products that were used, right? How much did those cost you? The screen, whatever the screen material that whatever it's made up of, right? How much did that cost you, and all that, right? So when you subtract these components, the cost of these components from the final price of the good, that gives you value added. That gives you value added, right? So that's the idea. Okay, is this clear? Okay. Right. Now, this being said, let's move forward from here, and let me tell you what we'll do next, right? Right. Okay. Now, quick recap, and then I'll tell you what we will do next, right? So we said, what is national income? As the word suggests, national income is the total income of all the people who are living in a country. First thing, right? Then how do we calculate national income? So national income is calculated through four statistics. So there are four statistics for estimating or calculating national income. The first one is gross domestic product. The second one is gross national product. The third one is net domestic product, and the fourth one is net national product. Now, gross domestic product is the basis for calculating all the other three statistics, as you mentioned. Now, what is GDP? Gross domestic product is income of all the people who are living in a country, whether they are that country nationals or not, right? So anyone who is living in Pakistan, whatever income they earn, that would be part of GDP. Okay, fair enough. But sometimes country want to only estimate the income of their own nationals. Sometimes countries want to estimate the income of their own nationals, which means that they don't want to have foreigners' income included in it, but you want to include the income of your nationals who are living abroad. So to calculate gross national product from GDP, what you do is that in GDP, you add net income from abroad. Now, what is net income from abroad? Net income from abroad is income that our nationals are earning abroad. Whatever I'm sure in your family as well, there would be some people living and working abroad. So whatever income they earn by working there, that minus the income that foreigners are earning in Pakistan. So if there are any Chinese, any Americans, any country nationals who are living and working in Pakistan in embassies, in their country embassies, or in some Pakistani or some international businesses or whatever, right? So we subtract their income, our income of our nationals living abroad minus income of foreign nationals living in that country, that gives you net income from abroad. So when you add this net income from abroad to our GDP, that will give you GNP, gross national product. Then comes net measures. So in net measures, what you simply do, you subtract the depreciation. So to calculate net domestic product, you subtract depreciation from gross domestic product. Similarly, to calculate net national product, you subtract depreciation from gross national product. And then we had some discussion that why are net measures better than gross measures? So net measures are better than gross measures because they account for the loss of value. Net measures account for the loss of value that your assets experienced during a certain period, right? So when you produce any product, any good or service, you use machines, you use equipment, you use furniture, you use office buildings, and these all assets of the business lose their value when you use them, right? So whatever value these assets lost during that 1 year or whatever time period, that is known as depreciation. So when you subtract that depreciation from gross measures, you get net measures. So oftentimes economists are interested in looking at net measures rather than gross measures, right? Okay, then how is GDP determined? Theoretically, it was fairly simple, that where the aggregate demand is equals to aggregate supply, that is where the country's GDP is. But how do we calculate GDP in real life? How is GDP estimated, right? How is GDP estimated? And again, think about this. Why are we using the word estimated? Because it's not always accurate, as we just discussed. Remember, right? So we did say that there will be few transactions that will not be part of, formal activity, formal economy. There's formal economy, and then there's informal economy. Formal economy is a registered business, as we were talking about, and informal economy is any business or any activity that is not accounted for, that's unregistered, right? Now, that's why we use the word estimated, because GDP is not always accurate. Now, the first one is income approach, right? So income approach is basically sum of income of all the people who are living in the country, and does how the government gets an estimate of that. So government gets an estimate for that when people file their tax returns, right? So every person has to file their tax returns. When they do that, it gives them a total value of how much income all different people made during that time period. Now, but I did tell you that it underestimates, income approach underestimates GDP. Why? Because people underestimate their incomes to avoid taxes. Then comes in, yes, exactly. Understated. Very nice. Then comes in expenditure approach. In expenditure approach, what happens that you add up all the expenditure that your consumers, your country consumers, citizens made on different products, like how much worth of food was sold during certain time period, how much worth of clothes were sold during certain time period, how much worth of other products, cars and laptops and phones were sold, right? So when you add up expenditure, total expenditure from all these people, you get expenditure approach. Now, I did tell you that even expenditure approach is not foolproof, but because there are some businesses that are not registered. So if you buy any product from those businesses, those transactions will not be recorded in countries expenditure. Those will not be included in the country's expenditure amount. But it's still a better method or more accurate method, because it's difficult for the people to avoid their expenditure, whereas it's easier for them to understate their income. And I did give you an example. Then the last of all is the product approach. In product approach, you calculate the GDP of a country through the value added approach. Now, what's value added approach? So you take the difference of the selling price minus cost of components. If you do it for all the different products, then you get the product approach. Is making sense? Is this simple, right? So that's the idea here, right? Okay. Now the next thing that we have to do, Mubin, is GDP, and that's this topic that we are just about to start. This is very important from exam point of view, right? Is GDP a good indicator of development? Is GDP a good indicator of development? So that's what you need to ask yourself, right? Okay. Now the idea is GDP a good indicator of development? Okay. What we will talk about in this, right? So we'll talk about the idea that, first of all, you need to know what development is. Right? What is development? Right? So development is basically an estimate of the living standards, how high or how low, right, are the living standards of citizens in a country. Right? It refers to the uh, living standards of a country nationals, right? Okay. Now, what comprises what affects living standards actually in reality? That's another thing that you need to know. So think about this. Let's think about it. So quality of life. If you think about quality of life or living standards, you can easily understand that there are a couple of things that affect that. How good are job opportunities in that country? How much education, how much quality education is available? How much quality healthcare is available? Then whether there is there's there how high are the pollution levels, how low are the crime rates, and all these things, right? So these are all the things that affect the development of a country, right? And then after we discuss tomorrow, after we have discussed that what are different, what is development and what things affect development, then we will talk about if GDP is a good indicator of development or not, right? Then we'll talk about if GDP is a good indicator of development or not. And if GDP is not a good indicator of development, then what are other indicators of development, right? So these are the questions that we'll talk about tomorrow, but I'm just giving you some roadmap. What affects living standards? What affects living standards? Or you can write slash development, right? Is GDP a good, above question, GDP a good indicator of development? Another thing, if not, then indicators of development. Right? So these are the three questions that we'll be talking about tomorrow. Easy. We good on this, right? So Mubin, I'll see you tomorrow at the same time. We'll try to get our class started by 7, right? Good. So I'll see you then. Take care and have a good night. Allah Hafiz. Allah Hafiz. Take care. Allah Hafiz.